In the last 12 months, the top 7 U.S. stocks accounted for over 90% of the S&P 500's total gains, while more than half of the index delivered flat or negative returns. That number is not a forecast. It is already recorded. It exists now. It tells us something structural has changed beneath the surface of the market. Most public attention, however, is elsewhere, focused on headlines, focused on narratives, focused on what has already happened, rather than what is quietly unfolding. Institutions rarely announce transitions in real time. They move gradually. They rebalance silently. And only later does the explanation arrive, usually after the returns are already captured. Welcome to the Finance Historian. This channel examines markets the way historians examine empires, not through emotion or prediction, but through patterns that repeat under different names. If you find this kind of analysis useful, take a moment to press the like button. It helps surface long-form, calm explanations in a noisy environment. And if you're new here, consider subscribing. Before we continue, pause for a moment and tell us in the comments where you're watching from. Markets are global, but the experience of them is local. By the end of this video, you will understand 3 things. First, what is happening beneath the surface of today's stock market. Second, why this shift is occurring now and why it is not random. And third, what history shows typically follows after this stage appears. This is not an argument. It is not a warning. It is an explanation. What we are observing is a rotation, not a crash, not an exit, but a reallocation. Capital moving away from one set of assumptions and toward another. From growth narratives toward cash flow resilience. From future promises toward present durability. From expansion toward defense. These rotations do not require panic to occur. In fact, they usually happen during periods of public optimism. To understand why, we need to step back. Far back. Across centuries, not quarters. Because markets, at their core, are not emotional systems. They are constraint-based systems. They respond to interest rates, to energy costs, to labor scarcity, to capital availability, to geopolitical friction. And when those constraints shift, capital responds. Not loudly, not immediately, but consistently. There is a historical cycle that explains this movement. It has appeared under different technologies, different currencies, different political regimes, but the structure is remarkably stable. It begins with abundance, cheap capital, optimism, narrative expansion. It progresses through concentration. Returns narrow, leadership tightens, risk becomes unevenly distributed, and eventually, it moves toward preservation. Not because investors become fearful, but because the system itself becomes less forgiving. This cycle is not ideological. It is mathematical. It is driven by the relationship between returns and constraints. In the early phase, returns are high and constraints are low. Growth is rewarded. In the later phase, constraints rise. Returns compress, and capital adjusts. We are not at the beginning of this cycle, and we are not at the end. We are somewhere in the middle. To see that clearly, we must first understand the cycle itself, not as a theory, but as a recurring structure observable across history. To understand what is happening now, we need a framework that does not depend on headlines, personalities, or technologies. That framework already exists. It has appeared repeatedly across centuries of financial history, long before modern stock exchanges, long before central banks as we know them today, and long before the idea of growth stocks or defensive assets had names. At its core, it is a capital rotation cycle, not a market cycle measured in days or months, but a structural cycle measured in constraints. The cycle unfolds in a consistent sequence, not because investors agree with one another, but because capital responds to changing conditions in predictable ways. This cycle has 4 broad stages. They do not announce themselves. They overlap, and they often appear invisible to the public while they are happening. But in hindsight, they are unmistakable. Stage 1. Expansion under abundance. This phase begins when constraints are low. Capital is inexpensive. Liquidity is plentiful. Risk tolerance rises naturally. During this stage, the market rewards future potential over present stability. Growth outperforms value. Narratives outperform balance sheets. Innovation attracts capital more quickly than profitability. This is not irrational behavior. It is logical. When money is abundant and the cost of capital is low, the penalty for failure is reduced. Time itself becomes cheap. In these conditions, investors are willing to wait. They are willing to fund long-term visions. They are willing to accept volatility in exchange for scale. Historically, this phase is marked by rising valuations, broad participation, expanding multiples. Optimism framed as inevitability. Importantly, this phase often feels stable while it is happening. Risk appears manageable because losses are easily refinanced. Setbacks are temporary. Liquidity absorbs mistakes. Stage 2. Concentration and narrow leadership. Over time, abundance creates saturation. Too much capital chases too many similar ideas. Returns begin to compress. At this point, the market does something subtle. It stops rewarding everything. Capital begins to concentrate. Leadership narrows. A smaller group of assets begins to carry a disproportionate share of total returns. This is not a collapse. It is a filtering process. The strongest narratives survive. The largest platforms dominate. The most liquid names attract more capital simply because they can absorb it. Historically, this stage is defined by index-level strength with internal weakness, a widening gap between leaders and the average asset, increased volatility beneath the surface, growing dependence on a small number of winners. Public confidence often increases during this stage. Indexes reach new highs. Media coverage intensifies. Success appears concentrated but reassuring. This is usually when the phrase, "this time is different," begins to circulate, not as a slogan, but as an assumption. Stage 3. Constraint emergence. This is the most misunderstood stage. It does not begin with fear. It begins with friction. Constraints slowly reassert themselves. Capital becomes more selective. Financing becomes more expensive. External pressures, energy, labor, geopolitics, demographics, begin to matter again. The system becomes less forgiving. Growth does not disappear, but it becomes conditional. Narratives must now justify themselves with cash flow. Scale must translate into durability. Time becomes expensive again. This is the stage where rotation begins. Not out of panic, but out of necessity. Capital seeks resilience. Not because investors are pessimistic, but because uncertainty has increased and optionality has decreased. Stage 4. Preservation and defense. In the final stage, capital prioritizes survival over expansion. Balance sheets matter more than projections. Dividends matter more than disruption. Stability matters more than speed. Defensive assets outperform not because they are exciting, but because they are predictable. This phase is rarely celebrated. It feels slow. It feels boring. It often feels like stagnation. But historically, it is during this stage that capital quietly resets itself for the next expansion. These stages are not moral judgments. They are responses to changing constraints. They do not require a crash to transition from one to another. In fact, the most significant rotations often occur before any obvious market stress appears. That is why they are frequently missed. To see this clearly, we need to observe how this exact sequence has played out before. Not once, but repeatedly, across different centuries, different markets, different technologies. To see the present clearly, we need distance. Not distance from the market, but distance in time. History does not repeat in detail, but it does repeat in structure. When constraints shift, capital behavior follows a familiar path. We can observe this across multiple eras, each with different technologies, political systems, and financial instruments, yet remarkably similar sequences. Case Study 1. Britain, late 19th century. In the decades following the Industrial Revolution, Britain experienced a period of extraordinary expansion. Capital was abundant. Technology was transformative. Railways, steel, shipping, and mechanized manufacturing promised exponential growth. During the early phase, investors funded ambitious infrastructure projects with little regard for short-term profitability. Railway shares traded on expectation rather than cash flow. Valuations expanded rapidly. This was stage 1. By the 1870s, leadership narrowed. A small number of dominant rail and industrial firms absorbed the majority of capital. Smaller projects struggled to compete. Returns became uneven. This was stage 2. Then constraints emerged. Global competition increased. Input costs rose. Overcapacity reduced pricing power. Capital did not flee the market. It rotated. Investors shifted toward utilities, established manufacturers, and colonial assets with stable cash flows. By the end of the century, defensive income-producing assets dominated portfolios. This was not fear-driven. It was structural. Case Study 2. The United States, 1920s to 1930s. The 1920s are often remembered for excess. But the transition mattered more than the boom. Early in the decade, capital flowed into new technologies. Automobiles, radio, electric appliances. Growth narratives dominated. Stage 1. By the mid-1920s, returns concentrated. A small number of industrial and consumer giants carried market performance. Stage 2. Before the crash, something important happened quietly. Institutions began shifting toward bonds, utilities, and dividend-paying stocks. This was Stage 3. The crash did not cause the rotation. It revealed it. Afterward, capital overwhelmingly favored defensive assets for over a decade. Not because investors lacked imagination, but because the system had become constrained. Case Study 3. Japan, late 1980s to 1990s. Japan's asset boom followed a similar structure. In the 1980s, capital was abundant and cheap. Real estate and equities were valued on future dominance rather than current earnings. Stage 1. Leadership narrowed dramatically. A small group of banks, conglomerates, and property firms drove returns. Stage 2. As interest rates rose and demographic pressures intensified, constraints appeared. Capital rotated, not suddenly, gradually, toward cash, bonds, and defensive sectors. The collapse is often blamed on policy mistakes, but the rotation had already begun. Case Study 4. The dot-com era. The late 1990s were defined by technological optimism. Capital rewarded potential over profit. Stage 1. By 1999, leadership was extremely narrow. A handful of technology stocks drove index returns. Stage 2. Quietly, institutions began reducing exposure to speculative growth and increasing allocations to value and defensive assets. This occurred before the Nasdaq peak. Stage 3. After the collapse, capital preservation dominated. Stage 4. Across these cases, the pattern is consistent. First, expansion under abundance. Then concentration. Then constraint. Then defense. The technologies changed. The cycle did not. At the midpoint of this script, it is worth pausing. If this historical perspective is helpful, take a moment to like the video and subscribe to The Finance Historian. This channel exists to slow the conversation down, to replace reaction with recognition. When mapping the present onto a historical framework, the goal is not to predict outcomes. It is to identify position. History does not tell us what will happen next. It tells us where we are relative to what has already happened before. And the current position is increasingly clear. Public narratives still describe this as a growth-led market, an innovation-driven expansion, an era defined by artificial intelligence and technological acceleration. But capital behavior tells a more precise story. We are no longer in the phase where abundance is broadly distributed. Liquidity still exists, but it is selective. Financing still flows, but it is conditional. This is not Stage 1. Leadership is already narrow. A small number of companies continue to dominate index-level returns. The majority of stocks lag, stall, or decline quietly. This is Stage 2 moving into Stage 3. We can see this in multiple places. Valuation dispersion has widened. Earnings growth outside the top tier has slowed. Credit conditions have tightened unevenly rather than uniformly. Most importantly, institutional allocation behavior has shifted. Pension funds have increased exposure to dividend-paying equities. Insurance portfolios have lengthened duration in high-quality fixed income. Sovereign funds have reduced marginal exposure to speculative growth. These are not reactions to fear. They are responses to constraint. Interest rates are no longer negligible. Energy costs are structurally higher than the previous decade. Geopolitical fragmentation has introduced friction into global supply chains. These forces do not end growth. They price it differently. Capital now demands compensation for time, uncertainty, and leverage. This is the defining feature of Stage 3. Growth does not vanish, but it must coexist with durability. And when that happens, capital begins to rotate. Not out of equities entirely, but within them. From companies that require ideal conditions to justify valuation toward companies that function acceptably under less than ideal conditions. This is why value has quietly begun to outperform growth on a relative basis. Why defensive sectors show improving relative strength. Why cash flow visibility is increasingly rewarded. The public often expects rotations to be dramatic. They are not. They are incremental, measured, often boring. And that is precisely why they are missed. When capital rotates, it does not issue warnings. It simply reallocates. History shows that once this process begins, it tends to persist longer than expected, not because of sentiment, but because constraints, once present, are slow to reverse. The consequence is not collapse. It is repricing. Returns become harder to generate. Volatility becomes more selective. Mistakes become more expensive. For individuals, this environment does not demand panic. It demands awareness. Periods like this reward preparation rather than speed, understanding rather than reaction, flexibility rather than conviction. Historically, those who fare best are not the ones who predict the future. They are the ones who recognize the present accurately. They understand that markets are not narratives. They are systems, and systems respond to pressure in predictable ways. What we are witnessing now is not the end of innovation. It is not the failure of growth. It is a rotation toward resilience, toward assets that function under constraint, toward balance sheets that absorb shock, toward income streams that do not depend on ideal outcomes. This shift does not announce itself. It unfolds quietly, and by the time it becomes obvious, the adjustment is already advanced. That is the lesson history repeats. Not loudly, not urgently, but inevitably. If this perspective helped clarify what you're seeing in the market, take a moment to press the like button. It helps this kind of long-form, historically grounded analysis reach those who are looking for understanding rather than noise. And if you value this approach, consider subscribing to The Finance Historian, because the pattern is already visible, and it is already unfolding. One of the consistent errors people make when studying markets is assuming that importance announces itself. It rarely does. Historically, the most consequential shifts feel uneventful while they are occurring. They appear ordinary. They register as subtle reallocations. They are often dismissed as temporary or technical. Only later do they receive names. The Nifty 50, the dot-com boom, the housing cycle, the AI trade. These labels are applied after capital has already moved. During the transition itself, there is usually no drama, just a quiet change in relative performance, a slow decline in tolerance for leverage, a gradual preference for certainty over scale, a widening gap between stories and statements. That is what makes rotations difficult to accept in real time. They do not feel like turning points. They feel like noise. But when historians look back, they do not ask what people believed. They ask where capital went. And the record is always clear. Capital does not move because it is emotional. It moves because the structure changed. When capital was cheap, it behaved one way. When capital became constrained, it behaved another. This is not ideology. It is arithmetic. The present moment fits cleanly into that arithmetic, not because the future is known, but because the conditions are known. Higher friction, higher selectivity, higher cost of error. Those conditions do not end markets. They change what is rewarded, and that change is already visible. Quietly, incrementally, without headlines, which is why most people miss it. Until later. If this kind of historically grounded, system-level analysis is useful to you, press the like button so it reaches others who are looking for clarity rather than urgency. And subscribe to The Finance Historian, because the most important shifts are never the loudest ones. They are the ones already underway.